Has Wall Street finally lost its appetite for the energy drink stocks? I mean, here's a group that's had some stunning performance over the last 20 years. You think Alphabet's up big from its 2004 IPO with that 7,890% gain? Man, if you bought Hanson Natural, which is the company that became Monster Beverage at the same time, you'd now be up more than 24,000%. Meanwhile, in just the last 4 years, Celsius has rallied more than 4,700%. These things have been incredible winners. I mean, you think that they're AI. You think that they're, I don't know, networking or something. But in March and April, both Monster and Celsius turned ice cold, along with so many other formerly beloved growth stocks. Monster was down more than 15% in just over a month before stabilizing in the low 50s. Ahead of its most recent earnings report last Thursday, Celsius plunged over 30% from peak to trough. I was starting to lose faith here. It rebounded a bit going into this quarter on Tuesday. So when we saw the actual numbers, did these declines turn out to be justified? Let's start with Monster, which has given the bears a lot of ammunition over the past year. After the company last reported in late February, its stock shot to a new all-time high in mid-March, but the fourth quarter results actually weren't that good. In fact, they missed on nearly every line. Monster only rallied in response to the quarter for one reason. They told us that their currency-adjusted sales growth had accelerated to 20% in January, which was very impressive. But after the stock peaked and rolled over in March, sentiment quickly turned negative again. It reached a crescendo on April 25th, a week before Monster's first quarter report, when two analysts downgraded the stock on the same day. Hey, one of these truists even hit the one with the dreaded double downgrade that you hear about. That they go from buy to sell. They don't stop at hold, arguing that margin expectations were too high. Stock was simply overvalued. So what happened when Monster reported a week ago? You might think they proved the skeptics wrong because the stock rallied 3% the next day, but that's actually not true. Monster's currency-adjusted sales growth came in at 15.6%, which would have been fine, except everyone got excited about that 20% growth number for January, meaning there was a major decel, as we call it, deceleration in February and March. Net sales were in line. Their gross margin improved a bit year over year, but Monster's operating expenses were also quite a bit higher than expected, and these guys missed on all the earnings lines. While Monster doesn't give much formal guidance, the company did disclose the currency-adjusted sales grew by 12.9% in April. Clearly, things are slowing down. I didn't like that. All in all, not good. So why did the stock rally in response to the quarter? Two reasons. First, expectations were relatively low going into the quarter, and the headline numbers weren't horrible, even if I can't call them good either. Second, Monster announced, and this was really interesting, a modified Dutch auction-style buyback for up to $3 billion of its own stock. In other words, they thought their stock's very undervalued, which is a substantial chunk of change for a $57 billion company. That said, worth noting, both co-CEOs intend to sell some of their shares back to the company. By itself, insider selling doesn't necessarily mean anything, but it's definitely not a positive sign. Take away the buyback announcement, and I think Monster would have sold off a lot. Celsius, though, is different. From mid-March to late April, the stock lost more than 30% of its value, which was breathtaking. That was largely because Celsius announced an amended distribution agreement with PepsiCo, which they already had an existing agreement with, and it says to quote, and I'm going to quote here, it's a little confusing. I was confused when it came out. Incentivize and compensate the distributor for its continued focus on the end actions to support, quote, end quote, Celsius products. Nobody knew exactly what that meant. I sure didn't, but the analysts assumed that more compensation for PepsiCo is bad news for Celsius. The stock actually dropped 8.5% on the news as people sold first, asked questions later. Fast forward to Tuesday morning when Celsius reported its first quarter results. At first glance, it looked like a mixed quarter. This company posted a substantial revenue miss. They did under $356 million in sales when Wall Street was looking for $390 million, but the margins were fantastic. Celsius's gross margin expanded by 740 basis points year over year, much higher than expected, which translated to a 7-cent earnings beat off 20-cent basis. I like that. These guys had 108% earnings per share growth year over year. Now, on the conference call, management said the revenue hit came from, and I quote, inventory movements, end quote. So hard to understand, for their largest distributor, which is PepsiCo, which, again, I told you owns a stake in this company. Long story short, Pepsi had a big restock in the first quarter of last year that didn't repeat itself this year. Celsius also indicated that PepsiCo plans to keep its inventory tighter this year. That's not great news, especially since we don't know how long this will last. But it's a legitimate explanation for the revenue shortfall, and crucially, it's got nothing to do with demand, which is what I care about. Once the analysts update their forecast to account for PepsiCo's planned inventory changes, I bet Celsius will be just fine going forward, because other than that one issue, business is real good. Although Celsius doesn't give much in the way of formal guidance, management reiterated a previously stated goal of getting their full-year gross margins to the high 40s. Perhaps that was a disappointment because their first quarter gross margins was in the low 50s. But the CFO noted that they're taking a conservative approach to forecasting the remainder of the year, thanks to the possibility of rising costs. I get that. I don't see the costs rising. Plus, there are plenty of positives here. Celsius continues to take market share in the energy drink category, reaching 11.4% by the end of the first quarter. Now, that's up a full point. That's a lot from the fourth quarter, and up 4 points from the same point last year. That's huge. Hey, by the way, as Celsius steadily gains market share, the top two players in the space, Red Bull and Monster, keep losing share. On top of that, management sounded an optimistic tone, although they always are optimists, about the spring shelf reset season. Now, that's something we've recently seen about when we talk about Constellation Brands, which expects to see big shelf gains from Modelo this year, thanks to the success last year. Celsius expects big shelf gains, too, possibly the best in the company's history. Once you gain shelf space, obviously your numbers could go higher. Finally, Celsius has only just started to expand internationally. Canada's sales began in January, the UK and Ireland last month, France, Australia, and New Zealand are all coming up in the fourth quarter. Could be a major source of upside surprise over time. Ultimately, the sales miss and PepsiCo's inventory noise, coupled with management's decision not to commit to a higher gross margin target for the full year, led to a modestly negative reaction to Celsius' quarter, stock slipping 1.8% on Tuesday. But after looking into the quarter, I'm pretty sanguine about the situation. I guess so's the rest of the street. It's come around to our view as CELH shares jumped more than 6% today. I mean, I'm sure there are some people out there who must be thinking that PepsiCo wants to buy the rest of them or something. By the way, if I were PepsiCo, I would want to buy the rest of them, too, because this is a growth category. Hence, here's the bottom line. Monster saw a small bounce when it reported, but mostly because it also announced a big buyback. I'm not particularly impressed with their latest numbers. Celsius, on the other hand, which is a company I've liked for a long time, they've been on many times, gave us a noisy quarter that masked the true strength of the business. The market's now giving the company credit for the result, but the stock's still down about 18% from its highs. I think this is a very good entry point, even though I don't like it up 6 today. At the end of the day, though, you want to own shares of the company that's taking market share like Celsius, not the ones that are losing share like Monster. And I got to tell you, when it comes to taste, which of course there's no accounting for, count me in as a Celsius drinker. Only after 4 cups of coffee. Let's go to Brian in Wisconsin. Brian.
Hello, Jim. How you doing?
I am doing fine. How you doing, Jim?
We're doing good. We're doing good. Thanks for taking the call and for all you do. See, my
no
question
problemo.
is on ConAgra. They've had a lot of ups and downs and changes over the last 8-10 years. Wondering what your outlook is for CGA.
Okay, thank you for the call. Now, here's what I'm going to tell you. Sean Connolly has got a decent hand. They're not the greatest brands, but it yields 4.5%, sells at 11 times earnings. I am never going to criticize anyone for buying with those characteristics. I think you'll be fine. Let's go to Scott in my home state of New Jersey. Scott.
Jim Cramer, I've been watching you since you started on television.
And you're certainly you might be 70.
Yes, I am.
All right, good enough.
Thank you for all the wisdom that you've imparted to
I appreciate that. Thank you.
Years.
Thank you.
And how about those Phillies, Jim? How about those
best
Phillies?
team in baseball? Thank you for mentioning it. Last night lost, but that's okay. We just sweat. I mean, they're bringing great joy to my household. Let's put it that way. So how can I help?
They're bringing great joy to us down here in Margate Land as well. So.
Oh my God, Margate! You might. Oh my God! You know, Jeff Marks, my partner in crime, he goes down to Margate all the time. Yeah, and I used to be friends with Lucy. I don't know if you know who Lucy is, but
Lucy's right around the corner from me.
I my
look
girlfriend.
At her rear every day. I see it from my building here.
That happens to be a giant elephant. Let's not make any conclusions. All right, let's get to work. Maybe we get to work. Maybe we stay more focused. I'm sorry.
Here we go. Get to work. CVS. I've been taking a beating on my CVS stock. What do you think, Jim?
Oh, geez. You know, I think the world of Karen Lynch. I think it yields 5%, but they're in a very hard category. They're trying to make healthcare work. They're trying to make the small format stores work. They have to deal with the current stores and the problem against Amazon. It may be too much for her to handle, but if she wants to come on and talk, I'm more than welcome because she's cerebral and she's got a plan. So that's my goal, but that's, the jury's still out on that one. All right, guys, when it comes to the energy drink category, which I care about passionately, you want to own shares of Celsius because they're gaining share. Unfortunately, Monster is not gaining share, and I don't know. It's kind of orphaned right here. Right, much more made money, including a really cool piece that we've worked on about retail REITs. I want you to know which ones are the greatest. You also get some yield. That works all the time. Then I'm focusing on the crux of what's become a great debate around the Fed's next move. You do not want to miss this one. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.